one person that voted for moving interest rates up this year. So. How to view it? Top. Oh,
there you go.
Everyone ready? Okay, good morning, ladies and gentlemen. My name is Sierra. This is Timo, Spencer, Hannah, and Brandon, and we're going to discuss our recommendations for the Fed at the Federal Open Market Committee meeting. So this is our agenda for today. First, we're going to discuss the status of the recovery. Then we're going to look at the Fed's balance sheet. Next, we're going to look at a variety of economic indicators reflecting and supporting our recommendations. And finally, we'll talk about the policy action. So, status of the recovery. With the housing market, we graphed permits, starts, and completions. And as you can see, during the recession, 2008 to 2009, the construction on housing, it decreased drastically and then leveled out around 2010 to 2012. However, as you can see, from 2012 to the present day, we see a steady increase. And what this means is constructions of new homes, and all of these, because they're cyclical, they're all trending in the same direction. And constructions of new homes are on the increase. And this is indicative of an economic recovery. This also reflects a similar trend. This came from the Standard & Poor Case Shiller Index. This is the National Housing Price Index. And as you can see, again, there was a steady decline during 2008 and 2009, but we're expecting housing prices to increase in the near future. What this means is the values of people's homes are steadily increasing, and we can see that this is indicative of economic recovery. Next, from the University of Michigan and Bloomberg, we gathered information on consumer sentiment, which means that today people are having a more optimistic view on the economy, and in the future they can expect their wages to increase, they can expect a variety of economic indicators to increase. The general trend of this is positive, and for example, more people are buying more, so we notice an increase in consumer expenditures. And for example, we've seen a steady increase to recessionary levels for the number of vehicles that people are purchasing. So light vehicles and light trucks. And this is indicative of people having more personal disposable income as well as work increasing.
And now I will talk about the Fed's balance sheet. So as you can see from the securities held outright line item, the Fed is increasing the securities they're holding, and that's due to them implementing their quantitative easing policy, where they buy different types of securities to pump more money into the economy. And you can also see on their liabilities, one of the major changes is the other deposits held by depository institutions that also had a big increase, so the Fed is holding more money for banks. And then now we'll look at the price levels of the indices. So the first price indicator that we're looking at is core CPI-U. And you can see that there was a large decline in the CPI. However, it has risen back up to just about pre-recession levels. And then if you look at the core PCE, that has also seen a sharp decline because of the lack of spending that consumers have done since the recession. And then if we look at the GDP deflator, you can see that that is also moving back up towards where it was before the recession. Real disposable personal income is also slowly increasing over time, even though it has seen a couple of sharp changes since the recession. And then we also look at employee wages and salaries, which is also slowly increasing.
When it comes to the labor market, like many economic indicators, there are no clear-cut ways to determine its constitution by examining just one factor. One must examine many different aspects to clearly and concisely make statements on the effect of federal policy on the U.S. economy. The go-to indicator to describe the health of the labor market is the unemployment rate. Soon following the recession, the unemployment rate reached a high of 10%, but since then has decreased and now rests near 5.9%, nearing the target range between 5.2 and 5.6. This should be an indicator of economic health and stability in the labor market, but if you take into account the discouraged workers, the rate rests at 6.4%, which is another 0.5% higher, and the U6, which is much more realistic of the current amount of potential labor available in the economy, has fallen from a high of 17.2% in April 2010 to what is now 11.8%. The average mean duration of unemployment has been falling since 2012. When put together, all of these are indicative of slack in the labor market or underutilization of labor. This is the ISM Manufacturing PMI Composite Index, and though the PMI Composite Index was below 50 during the recession, it has been above 50 since, and that means that there's an expansion in manufacturing. This is leading to an increase in quits as people become more confident that they can find another job. And also you can see a steady trend in job openings and hires. And while the job market looks promising, the civilian labor force participation rate has decreased since the beginning of the recession from 66% to 63%, which is a 3% decrease that is substantial to analyzing the current condition of the labor market. As jobs look more appealing and more steady, many of the people that dropped out of the labor market should rejoin and begin looking for work in accordance to the job openings. And until this occurs, it would be unwise to increase interest rates as the economy is still trying to equalize. While there is slack in the labor market conditions index has been above 0% since right after the recession, mid-2009, which enforces that the labor market is recovering its health. Likewise, the level of activity has been on the rise according to the labor market conditions index, and the momentum has been positive since 2009. Overall, while the labor market seems to have recovered and is nearing its target unemployment level, it would be reckless to begin raising interest rates at this point in time. This could cause a scare in the labor market.
In the financial sector, we've seen growth and recovery. As you can see here, banking profits are reaching pre-recessionary levels with profits recorded this last quarter over $40 billion. This is aided by increases in consumer lending, commercial lending, and capital expenditures. In fact, the consumer lending increased 6% from this time last quarter. Consumer lending 6% from this time last quarter. Commercial lending is up 12% from this time last quarter, and capital expenditures have increased as well, showing that employers are increasing their investment in capital, plant, equipment, things like that. Now, this lending is fueled by the near zero level interest rates. And what this is doing is help banks lend at a really fast rate, which is indicative of an economy in recovery. However, over the last few days, we've seen a sharp downturn in the economy, with the S&P losing everything it has gained over the last year, and the Dow losing everything it has gained as well. In fact, the Dow is actually starting to lose on the year, and the S&P dipped below its 200-day average for the first time since November 2012. Now, people are calling this the correction that has been forecasted for a year where it really is not, at least not yet. A true correction is when losses get down to 10% or more, and we have not yet seen that. Now, with these losses, volatility index has increased, so people are seeing more risk in the economy and see more volatility in it. And as you can see here, the green line is the S&P and then the volatility. And this is just the past year with a few dips. You can see the jump, but this last downturn, you can see a 60% deviation from the mean in volatility. And this is just showing how risky investors are viewing stocks in the market. Now, there's a few things we believe cause this, but there's one in particular. The first is the Ebola outbreak is raising a lot of risk and concern in the market environment. The second is the unrest in the Middle East with the ISIS. But the third, the one we're most concerned, is the weak global economy. The lack of growth in the overall kind kind of stagnant state of the recovery has led many to get out of the stock market and into the bond market. And in fact, so much so that the 30-year T-note has dropped below 3% for the first time in over a year, and the 10-year note is down to almost 2%. So all in all, even though banks are showing signs of strong recovery, the market is not showing as strong of a sign. So we believe that to avoid risk of even more severe of a market downturn, the Fed should keep rates stable and low.
Right, let's talk about the international market. And starting, let's look at the exchange rate of the US dollar for the euro and the British pound, which are two of the strongest currencies in the international market right now. Well, first we can see there's a positive correlation and both are trending pretty similar. And since the early 2013, to check out the graph, the US dollar depreciated against both currencies, but then already in the first quarter of 2014, we see that the US dollar actually appreciated against both of the currencies. Going to the second quarter of 14, which we're in right now, which is April to June. For the second quarter, the US dollar's nominal weighted exchange value actually decreased by 1.2%, as measured by the Federal Reserve Board. But as we can see here, against individual currencies, the dollar's performance was a little mixed. So we have US dollar appreciation as well as depreciation. If we look at the trend of the whole year, we can see that the dollar appreciated against a lot of currencies, and we can still see that the dollar is a strong currency, because if we look at Canadian dollars, Mexican peso, Chinese yuan, Australian dollars, etc., you still need more a foreign currency to purchase $1. As mentioned before, we see British pounds and euro. They're still stronger than the dollar as of right now, but over the year trend, we can see the dollar appreciated against all of the currencies. The U.S. monetary authorities did not intervene in the foreign exchange market during this quarter. They didn't intervene last quarter, and since 1995, they actually only intervened twice. Okay. So the foreign exchange rate are a particular concern to governments because the change in the foreign exchange rates can affect the value of products and financial instruments. And as a result, an unexpected change or large changes can affect the health of a nation, as well as influence export and import prices. And these factors, in turn, can influence inflation and economic growth. So if we look at net exports of the U.S., the first thing we see over the past 14 years, we've been at a trade deficit, and this deficit even goes further back. But the graph we just started at year 2000. So, as we can see, during the recession, we see the dollar depreciated, which is due to expansionary monetary policy by the Fed, which depreciated the dollar and made exports from the U.S. more attractive to foreign countries. So our imports decreased and our exports increased, which decreased our trade deficit right here. The rapid trade growth acts as a transmitter for economic stimulus around the whole globe and a vehicle of continued recovery, and we're still in the recovery. So according to the Office of the United States Trade Representative, for the past 18 quarters of recovery, the U.S. real GDP is up 2.3% at an annual rate, which has been said before, and exports have actually contributed 1/3 to this growth.
Okay, and now for our policy recommendations. The slow recovery of the housing market, the improvement in the financial sector, the questionable improvement, the appreciation of the dollar, and the slack in the improving labor market all point to the effectiveness of the current policy action. And since there is improvement in the economy, it is appropriate to pursue a less aggressive quantitative easing approach to asset purchasing while maintaining these low interest rates. And interest rates should continue to persist at these low levels until the slack in the labor market is rectified, stabilizing at a low unemployment rate between 5 and 6%. And inflation, though not up to the target 2%, we should maintain that target of 2%. And once these qualifications are met, which is not time dependent, but rather dependent on the data, it would be prudent for the Fed to begin raising the interest rates while at the same time no longer reinvesting the expired securities that they hold into further quantitative easing methods. And to balance this decrease in the monetary base, there should be a proportionate increase in the interest paid on excess reserves, which will act as a lower bound to the Fed funds rate to protect against future